yet another question on CAPM, but this time we're going to look at pricing. How do we figure out whether an asset is underpriced, overpriced, or fairly priced? This is the question that you typically see on an exam, and for some reason, students sometimes kind of struggle with what this means. And if you're going to be studying finance or some subset of commerce in the next, in the next courses, you may need to actually understand this. And this is actually the beauty of CAPM. So we're going to show you, I'm going to show you how to work through this. I guess it's been a little bit too long that I've been working on questions all day. I'm talking like it's only me. But all jokes aside, we're going to work on this question together. I'm going to give you all the intuition you need to really understand how to find whether a asset is under, over, or fairly priced under the capital asset pricing model. Super, super awesome. Now, what I'm going to ask you is hopefully you have your formula sheet open and hopefully you have mine open, because it tells you exactly what you need to know and exactly what to do with this type of pricing question. And I'll actually show you right now, just to jump through. If you go in my formula sheet, you actually have, and I'm sorry that it's trying to populate, but you actually have a run through, although kind of dirty, on what to do in terms of figuring out whether something is underpriced, fairly priced, or overpriced. But don't you worry, we're going to build that from scratch together and we're going to make sense of it. Okay? So let's read the question, then I'll kind of work with the formula sheet a little bit. Okay, so we're looking at PepsiCo, and PepsiCo has a beta of 0.57. Okay, so we know that the beta of PepsiCo is equal to 0.57. And we know that the return on PepsiCo seems to be 6%. So the expected return on Pepsi right now seems to be 6%. And we're also telling you that the return on the expected, sorry about that, but the expected return on a market index right now, well, it seems to be 13.7. That's a pretty dope number, right? Seems like March 7th. And the risk-free rate is 2.8%. But before we do that, let me just quickly write that the market index right here, ERM, is 13.7%. Now, I'm sorry if I'm a little bit choppy, just because this is my 19th question at this point. I've been grinding all day, trying to get you guys all the questions possible. For those who are taking the summer class right now, for them to have as much tools as possible to study for their final and all that jazz. But the risk-free rate is 2.8%. Okay, the risk-free rate is 2.8%, such that RF is equal to 2.8%. Another really dope number. And we want to ask you, well, is PepsiCo overpriced, underpriced, or fairly priced? And that's going to be our mission for this question. We're going to try to figure out this quest. Not trying to sound like a nerd, but try to figure out what we got to do here. Okay. So the first step, really, when you see beta, you see market index or the expected return on the market, you see the risk-free rate, and it should click. Okay. Especially if you see overpriced, underpriced, and fairly priced, it should click that you need to use the formula for the SML. All right, the formula for CAPM. This should literally be, as in French we would say, une évidence. Okay, you should use the SML line, and the SML is written as being K is equal to RF plus beta times the market risk premium. Really as easy as that. And what's awesome is that in this question, we've identified a bunch of parameters. And these parameters, because you had your formula sheet, because you know the formulas, you could actually say, whoa, these are all in my SML line, or my SML, really. So we would have our risk-free rate, and I'm going to highlight these in yellow for continuity. We have a risk-free rate, which is 2.8%. We have our ERM, which is 13.7%. And we have our beta, which is 0.57. So we have a lot of good stuff. We just have to solve now for K. Pretty awesome. So let's go about doing that. And I guess I use blue right here. We would say that K is equal to, in this case, 2.8% plus, I'm losing myself, 0.57 times 13.7%. minus 2.8%. And we will be able to find the required rate of return on PepsiCo. So we'll call it like that, the required rate of return on PepsiCo. Now, this is the first time I've ever done this question. So I'm gonna go ahead and plug in all of this good stuff in my formula on Symbolab. So we have 2.8%, which is the risk-free rate. We have 0.57, which is the PepsiCo, which is PepsiCo's beta. We have 13.7%, which is going to be the return on the market. I'm just making sure I didn't make no mistakes. And we have the risk-free rate, which is 2.8. Such that, wow, we get that the required rate of return on PepsiCo right now is 9.013. Okay, so 9.013%. Okay, so let me tell you the so what here. What does this mean for us? And how can we use this to empower ourselves when taking the exam? So what we're going to do is we're going to just take a quick screenshot of our formula, and I'm going to place it real quick onto our little, like, I guess, book of problems. My English sucks. So we could take this right here, and this, as you could clearly notice, yeah. Okay, so this is our security market line. Okay, notice how, and I'll zoom in a little bit before we kind of like jump into the key takeaways. But notice a few things. Notice that within our security market line, we have some really cool information. We have beta on our horizontal axis. So that's going to be our independent variable. I'm so sorry, I'm tired. And then we're going to have on our y-axis, so our vertical axis, we're going to have our expected return. Okay, so that's awesome stuff. And what's really interesting is that you notice that we have this line here, which is obviously the SML, right? We have the SML right here. And I may actually even make this a little bit smaller. So we have the SML right here. And what we notice is that, of course, if beta is equal to 1, well, we're going to have the market portfolio, and we're going to have, you know, just what you should expect for having the given level of risk that the market has, okay? And what's awesome is that in this case, we told you a few things. We said, hey, we have PepsiCo, and PepsiCo, right, has a beta. If we want to actually even like follow through with what I did, we could actually say that PepsiCo has like a beta that's like around here, okay? PepsiCo has a beta that's around here right now, which is about 0.57. So we would say that PepsiCo's beta is equal to 0.57. And that's going to give you a specific return. And as you saw, it gives you a required rate of return of 9.013%. Okay? So you would require 9.013%. That's how much you would require for that given level of risk. This is an important topic to understand, because what the SML really showcases and what the capital asset pricing model tries to like identify for you is trying to tell you, well, hey, for a rational investor in a perfect world, what would be your required rate of return for any given level of risk? And we use the CAPM formula to do that, okay? And within the CAPM formula with the current inputs, it's telling us that if you have a stock, okay, like PepsiCo, with a beta of 0.57, you would expect 9.013% as your required rate of return, okay? But this is where it gets interesting. As you saw within the question, they told you, yo, man, your expected return right now on PepsiCo is 6%, okay? Let's try to plot that on our graph. Let's put it at a random point there, but we could obviously agree that if our vertical axis represents the expected return, the higher we go on our vertical axis, so the higher we are within this line, the higher the expected return, and the lower we are within this line, the lower our expected return, all the way to 0, right? I hope this is clear. And in this case, they're telling you that right now, for the given level of risk of PepsiCo, which is a systematic risk of 0.57, you're only getting 6%, okay? You're only getting 6%. Wow, you're getting less returns than you, according to the CAPM, should be getting, right? You should be getting, come on now, I'm gonna zoom in a lot. You should be getting 9.013%, but you only got 6%. I'm upset for you. That's not good. So this right here is how much returns you should have gotten. I'm just going to move a little bit. You should have gotten under the CAPM. Okay, that's what you should have gotten under the CAPM, right? If it were to hold. And we're going to assume in this world that it does hold. And this is a really interesting like little factoid, or I guess like little number. Because if we take a step back, like all the way to the top of the question, this leads us to a really easy insight. Okay, and I'm going to write it in green. Okay, this leads us to a really easy insight. This is telling us that what we got from our CAPM formula is actually bigger than what we got from our expected return. Okay, it's bigger than what we got as an expected return on this asset. So this is crazy to us. Okay, this is really, really interesting. This means that your required rate of return is bigger than the expected return on Pepsi right now. This means that right now, actually, this is actually really awesome. And if we could use our thing here, it would mean that right now, and I'll show you, it means that K is bigger than ERM, right? I mean, this is kind of wrong. Okay, this is kind of all over the place. I'm not gonna lie. So I'm gonna make it our own. But essentially, what this means for us, and I'll zoom in. I'm sorry about that nonsense there on the screen. But what this means for us, okay, and I'll kind of like highlight it on the screen. Give me a sec. What this means for us is that for any point, and I'll put it in I'm trying to find a good color, I'm not too sure. No, we'll go with this color. Okay. What this is telling us is that any point below our SML line, we actually get some pretty good insights. Any points below our SML line, it would mean that right now, for that like given level of risk, we're not making enough returns. Okay. So we could actually go ahead and highlight everything underneath the SML right here, okay, is what we're going to consider as being an asset that is overpriced, okay? And any asset that is over the SML line, right, that is making more than the required rate of return for that given level of risk will be considered to be underpriced. I don't know why I wrote it like that. God, my bad. Oh no. There you go. This will be considered to be underpriced. So what is this telling us right now? Like in terms of our answer? Well, in this case, we know that our expected return, of course, it lies below the SML. It's a point that is smaller than our required rate of return, right? Think about it. 9.013%, smaller than 6%. For that reason, PepsiCo is overpriced right now. We're not getting enough return for the level of risk. We're making less returns than what the SML is telling us that we should be making. That's not good. So it's overpriced. And you could actually use the graph to kind of empower you in that process. Now, I'm not going to lie, the graph is not as sexy as it should be, but still, in your formula sheet, could kind of make it your own, kind of walk through it. And actually, in a video that's going to be posted, if not like when this video came out, you will have another little segment on this idea of pricing, which is awesome. So another takeaway that I would like to give you, if the question said, well, you know what, the return on PepsiCo is actually 12%, and your required rate of return is 9.013%. Well, what does that mean for you? This means that, well, cool. This means that right now, PepsiCo is underpriced because for that given level of risk. So for a systematic risk of 0.57, a beta of 0.57, you would only expect to make 9.013%. However, you're actually making 12%. You're beating your expectation. You're beating your requirement. You're happy. That's the takeaway here. Now, the answer is clear. This is overpriced. All right, this is overpriced. Hope that's obvious. Okay, so this is overpriced. And just like that, we were able to walk through a pricing question, although maybe not in the most sexiest fashion, but we were able to do so nonetheless. Now, I hope that this question helps you out. It should give you some insights on what to do. And once again, if you go on ismahelps.com, you will find a bunch of content that will empower you to do amazing on your exam. And if you go on my YouTube channel, as you are right now, you'll be able to find like an amazing, like an abundance of questions, like videos, like 100 videos. So this is just my effort, of me giving back and really trying to hopefully inspire and help a few of you students kind of and make that difference there. So hopefully your studying is going okay, and hopefully I can help you too. Have a good one.